Episode 11, Risk, where professionals separate from everyone else. Most traders obsess over entries. Professionals obsess over invalidation. This episode is about risk, not as a defensive idea, but as a design principle. With Harmonia, risk is not guessed. It's defined before the trade even exists. Why most stops are emotional, not structural. Ask a trader where their stop is and you'll hear things like, below the last candle, under the swing low, X ticks so I don't get wicked out. None of those answers explain why the trade is wrong. They explain fear. Harmonia changes that by tying risk to auction failure, not discomfort. Invalidation is the only thing that matters. A trade is not wrong because it pulls back. A trade is wrong when acceptance fails, structure breaks the auction. Reverses. Harmonia gives you objective invalidation. Below EQ, the market returns to balance. Failure to hold 20% after acceptance. Early distribution failed. Re-entry into opposite distribution. The auction flipped sides. If none of those happen, the trade is still alive, even if it's uncomfortable. Stop placement. Using Harmonia, clean and logical. 1. Conservative risk. Below EQ. This is the structure must hold stop. Use it when the market just accepted volatility is elevated. You want room for rotation. If EQ fails, the thesis is dead. Not questionable. Dead. 2. Aggressive risk. Failure of 20%. This is for precision execution. Use it when acceptance is clear. The pullback is clean. You want tight R. If price closes back below 20% after acceptance, the market rejected continuation. That's not noise. That's information. 3. Never use arbitrary tick stops. If your stop exists only because that's what I'm comfortable with, it worked before, I didn't want a big loss. You're not managing risk. You're negotiating with fear. Harmonia removes that conversation entirely. Risk comes before entry. Always. This is non-negotiable. Before you enter, you must know where you're wrong, how much you're risking, whether structure justifies it. If you can't define invalidation in one sentence, you don't take the trade. Professionals do not see how it goes. They know exactly what failure looks like. Why small losses are a feature, not a flaw. Harmonia-based stops tend to be tight, frequent, unemotional that scares traders who want to be right more than they want to be profitable. Small losses mean structure was tested. You waited for confirmation, the market simply didn't follow through. That's not failure. That's filtering. One rule that saves accounts: never widen a stop because it should work. If the market breaks structure, it doesn't owe you anything. The fastest way to blow an account is to argue with an auction. Risk is what allows you to trade again. Tomorrow. The goal is not to win every trade. The goal is to stay solvent, stay objective, stay emotionally flat. Harmonia is a probabilistic framework. Risk is what makes probabilities survivable. What comes next? Now you understand where trades are invalidated, how professionals place stops, why small losses are intentional. In episode 12, we'll cover managing trades after entry, when to do nothing, and how most traders give back profits by being helpful. Because execution doesn't end at entry. That's where most damage actually happens.